Welcome back. We have Dr. Friday here to answer all your tax questions. It's the best time of year to start thinking about it because we just have a few weeks left in this tax year, and that's going to affect you come March and April of next year. So, Dr. Friday, one of our last callers was we were talking about the difference between here in the state and nationally. What are the things here in Tennessee that people really need to know? I know we did have a big change. I was there at the Capitol the day that they voted on the hall tax. So what does that mean for people?
Well, it's exciting in some ways for us because anytime we can reduce taxes, that's an awesome thing. So the hall tax is basically based on interest and dividends, capital gains earned through investment accounts. If you have a sub-S corporation and distributions, there are things like that that we pay tax on here in the state of Tennessee. We used to pay 6%. There's a few clauses in there where if you made less than $30,000 as a married couple and things like that, that you might not have to pay the hall tax, but all in all, it was 6%. It went down to 5% this year, and every year, 1% hopefully, and in 2022, it should be gone, which has been great. We don't have an estate tax here any longer. We'll not have it's lack of an income tax. It's not really based on income, but an income tax here. So it's becoming a much more attractive place to relocate.
Sure.
It's a good thing.
I do remember the governor was a little hesitant about it, though.
Well, because because he is, it's a couple, excuse me, a couple $1 million a year is coming in through this tax, right? So he has to redesign the budget to be able to account for being able to remove that from the tax code.
Sure, and the argument was made that, Tennessee's booming right now, but what happens if we do have a little downturn? Hopefully that doesn't happen, but I remember that was the argument.
Yeah, always have that in the back pocket that we can always keep it, and they've got 5 years to keep the budget going. So like I said, every year they have to elect to reduce it. So if 2 years from now they find that there isn't as much income coming in, they can elect not to pass the reduction of that 1% in that year. But we hope that by then they're kind of living off other means, sales tax, retail accountability tax. So we have a few other taxes in the state to make up that.
That we do. If you have a question for Dr. Friday, give us a call at 737+. We do have a few lines open right now. She'll answer any tax question you have. Throw it at her. Let's get to Linda right now. Linda, good morning.
Yeah. How long do you have to keep your tax records?
That's a great question. 7 years is what we say. The IRS will really only go back 2 years unless they find fraud. They can go back further. But ideally, keeping 7 years just in case. And also always keep, if you've purchased a piece of property or you've purchased stocks or bonds, those are lifetime until you've sold those products because those are our basis. So anything that you still own, and even though you haven't, if you've never sold it, keep all of those because those are not, even though people consider them tax records, those are bases, and that's really important over the long run. And
I know the idea, 7 years, people thinking about all that paper, where do I put it? You were talking about just scan it in.
I mean, think about nowadays, if you have a cell phone, you don't have to have high-tech equipment any longer. You can sit there, might take a while, but you can physically take pictures of all of it and then save those pictures in a file labeled whatever tax year you're working on. It doesn't have to be a high-tech going down and paying a lot of money for documentation to be scanned in.
Right. So you have lots of little tips and tricks for people. What are some of the other things that people just don't think about that are really easy that maybe you can do right now before the end of the year that can make a difference?
Long-term care. A lot of people don't think about that, but as a tax deduction, it helps you meet your medical deduction, which is very hard right now. Unless you're over the age of 65, it's 10%. People over the age of 65, 7.5% of your adjusted gross income. Another thing is mileage. A lot of people, especially again in medical, right? I mean, if you have someone that is got to go back and forth for therapy or a lot of prescriptions, those miles are tax deductions. So keeping track of all the miles. Same thing when you were mentioning charity. If you drive from home to the Goodwill, not only did what you contributed in that bag of sweaters, but the miles back and forth to drop it off are a part of your contribution. So again, anything we can put more money in our pocket is going to help you a lot. I mean, those are the kind, most people already know mortgage interest, property taxes, those kind of get put in their head early on in life. So, but I will tell you also is filing back taxes. It's really important that if you want to make a deal or you want to go buy a house or anything else, you have to be current. You can't even go bankrupt without being current with the IRS. All I'm saying is It's now's the time, and a lot of people will come to me. We do a lot of that, and a lot of times they'll come and they'll say, well, if I tell them where I'm at, they're going to kind of get aggressive. Well, that's not the way it really works. What they want is compliance. Yes, they do want you to pay your taxes, but you know what? Out of probably 50% of the people I do back taxes, they've left money on the table. They didn't realize that they were, that they actually had refunds coming because they just were afraid. One year they had a situation, and then after that they stopped filing because of some reason. It's really important to find out. We can only collect 3 years. If the IRS owes us money, we can go back 3 years. After that, hasta la vista.
You just leave that money on the table.
They are making it work for us.
All right, let's get to Julie. Julie, good morning.
Good morning.
What's your question for Dr. Friday?
Well, I have a son. He's 20 years old, and he has like a real mild form of cerebral palsy, and he's had a hard time finding a job.
Sure.
And he's 20 years old. I think I said that. Anyway, he did start work, and he's made less than, he's going to be making less than $6,000 this year, and he stayed with us.
He's a dependent, and maybe for the rest of his life possibly. And keep in mind, if he is receiving Social Security benefits, that doesn't make a difference. He can still be a dependent if he's working and making even a little over $6,000. If you consider the test of 50% of his care, and you consider room, board, food, transportation, all the things you might be pulling out of your pocket to help maintain any child, then you will probably still be able to claim him on your tax return. So yeah, he would definitely be a dependent for you.
And so any even adult child, as long as you're paying at least 50% of their needs?
Exactly. As long as you can do the test and figure out 50% of their needs, especially children with disabilities, though, because a lot of times they really can't get a full-time job in many cases. So homes are sometimes altered to be able to accommodate their disabilities and things, and a lot of that can also be a tax deduction.
Is there a cutoff date for age or anything like that?
No. There should be some children that aren't living at home, but there should be on some of my clients, but no, there is no age apparently.
So if a 35-year-old who is married and has a child moves back in with their parents, and their parents are covering half of that family's expenses, they will
entire
still
family
count.
Now again, if they're making $30,000 as a husband and wife, even though the parents, there is a means test that maybe they're living a little higher than they need to, so there would be a test. But in some cases, I have had many where the son, after divorce, and maybe the child will move back in, he hasn't been able to find work, whatever, so that the children and the can be a dependent for a year while they're getting back on their feet. Yeah.
All right, let's get to Tammy. Tammy, good morning.
Good morning.
What's your
question
question?
concerning the gift tax?
Yes.
What is the limit for 2016 in the state of Tennessee before a gift tax or a gift is taxed to the giver?
It's a great question. We don't have a gift tax in Tennessee any longer. Another win here. But there is a gift tax in the federal tax code. But again, you have a lifetime gifting of over $1 million. So unless you're really giving a lot of money, it's $15,000 per person. Anything above that, you need to file the gift tax return. But all you do is have to say who it is. There's no tax unless you get over $1 million.
And that's not including charity gifts?
No, this would be just a gift if I wanted to give you money or whatever. Yes.
For all the sweaters I'm going to give you.
Like my sweaters.
Those are the ones that I'm going to be giving before the end of the year, and I will keep my receipts on that.
All right, we'll test you on that.
That was a good question from Tammy. What about, I know that you are staying up to speed with all the IRS changes as they come in, and I think there can be so many, and they can feel kind of dense for the rest of us to keep up with. What are some of the big ones?
Well, that's the thing. Not too much changing for individuals. We don't have any really new. There's going to be tax bracket, inflation adjustments for all tax codes, but there's nothing in 2016 tax year really that's going to have any major effect for individuals. What you did in 15 is going to be fairly consistent to what you do in 16, with the exception of the hall tax. If you filed it, you will have a nice little gift of a less tax due because it's going to be 1% less. But as far as normal individuals, to be quite honest, we had some nice things. Section 179, again, usually falls on a business tax return. It has been made permanent every few years. We were losing it, and it was going back down to like $30,000. It's an accelerated depreciation. So if you went out and brought a big old truck and you need it for work, you sometimes times wouldn't be able to take 100% in the first year. Now you can, or you can take up to $500,000, which most small businesses would be able to use that. So it's been some nice advantages, but for the individual, not a whole bunch of changes.
Okay, great. Well, this has been very informative. We really appreciate you keeping us up to speed. Keep calling us, 737+. We're going to get back with more Dr. Friday in just a few minutes.